Scenes played out as U.S. crude oil futures turned negative for the first time in history. Zwelakhe Gila, an energy economist, joins me via Skype for more. Thanks so much for your time on SABC News. Explain to us how futures work and what this means.
Hi, Nzingam. Essentially, it is important to understand that with future contracts, you have an end buyer of those contracts, and at the same time, you have a lot of speculative players in those markets as well. So just to break it down very simply, you have people who are buying these future contracts at a certain price to be delivered at a certain date who have access to crude oil, and then you also have people who are playing within that market who do not have access to those products. So what we then end up seeing is a rollover, which is something that which is a strategy that traders can do with future contracts. In this particular instance, the riskiest aspect of these future contracts all kind of fell on to the same month, and with coronavirus included, it bottomed out. Therefore, it's important to note that the value of oil is not in fact $0, or I hear people saying that there's going to be free oil. That's not necessarily the case. However, what that does mean is that the future contracts that hold that oil have fallen at a alarming price.
And there was some confusion when this price was falling yesterday between WTI and Brent crude oil. What is that difference?
Essentially, between the two, WTI and Brent, they're both pricing indexes for oil. So instead of having each oil producer have their own prices, they all come up into a certain basket and index, and the pricing is then based on that. So with WTI, as you have noted, that is the West Texas Intermediates, and that pricing is essentially on the producers within that region, more closely with the Omaha. With the Omaha production of oil. So it's the Texas and the U.S. region of production, whereas Brent, which is a much larger index and encompasses 2/3 of oil producers, that is the pricing index for that. That's why we have seen a correlation of sorts, however, a separate impact between the two prices, with WTI falling harder than Brent. With the U.S. now having become a global oil supplier, the difference between those two prices is more prevalent now when the prices are going down. But we have seen Brent fall down slowly, and to our last research, we see Brent is now falling as well, even to $17. What will be more interesting, Zinga, is to see what happens in 9 days when the future contracts, when the May future contracts for Brent mature. It's going to be interesting to see what happens then.
Let's talk about how it's going to affect us on the continent. The African Development Bank developed a model to look at how high oil prices impact oil importing and exporting countries, and found that those high prices obviously a hindrance on those African economies, particularly those that have lots of debt. So what does this drop mean for them?
Well, we have a few large oil exporters in the continent, and they're heavily reliant on the exporting of that product. Now, unfortunately for those exporters, they will not avoid the perils that are affecting almost all markets, which is the fact that there is just not enough demand to be able to take on the product that is in the market. And so as we have seen now, the prices beginning to fall, and the future prices potentially for those countries as well will possibly face the same fate as the WTI futures. What that essentially says is that those countries which are heavily reliant on the exporting of that product are going to face a very difficult situation when the oversupply of the product and the volatile pricing of it do not allow them to be able to cover the margins that they need to make profits from these products. Personally, within South Africa, we will see a decrease in pricing right now. We do hold some large storage capabilities. It would be very interesting to see what CEF and the Central Energy Fund for South Africa does in order to play and position itself in a way to either assist these countries or to be able to take benefit of some of the volatile market. However, just in basic market terms, they have too much product. These producing countries have too much product in a market that is just not taking product right now.
So let's stay with that. Between 2007 and 2017, those African economies are said to have earned $3.3 trillion in revenue from oil. So what does this mean in particular for countries like Libya, Nigeria and Equatorial Guinea? And can we project now how much revenue perhaps is going to get lost?
To be able to predict revenue at this point in time is not only a difficult exercise, but it's one whose, the results of which are just so unprecedented. The fact that oil prices fell below, the future prices fell below $0, it's an unprecedented situation and an unprecedented response from the market. So to be able to predict what would happen you're predicting the outcome of something that's really never happened. But what the reality of it is, and the answers that these oil producing countries are going to have to face, is the lack of the capability to internally refine this product and store this product, which has been something on the back burner of the countries that you have mentioned for a long time. So the urgency of those solutions has now become even more real. The production capabilities of it are going to be the same. The production capabilities are going to be the same results as the production capabilities of many other commodities, pushing product into the market, just to say that the market cannot take these products. Now, the solutions are then storage and refining, which are now going to be pushed even more so to the forefront as urgent solutions to managing something like this from happening in the future again.
So how does the OPEC output cut play a role in what we saw happening with futures, if in any way?
Well, the OPEC cut actually comes at a very fascinating time, whereas the 9.7 million barrels a day that was agreed upon to cut did not shift away the effects that were going to happen with the future contract pricing. Now, that particular pricing cut does help the barrels of oil aggregately, but it's going to be interesting to see whether the future contracts of that same oil cut is going to be able to survive what might be inevitable or what might not be. It is a very volatile time right now in the energy sector. However, what we do think is going to happen and would be the future of oil is that the collaborative efforts in order to be able to managing pricing, as we have seen, might persist a lot longer than just this corona, just the corona market effect. So we might see that collaborative effort extend wider and for longer, which would then usher us into a very new phase of the oil market.
Zwelakhe Gila, an energy economist, joining me there via Skype. Thanks so much for your time and analysis on SABC News this afternoon.